2025 marked a new economic world order, marred by global shocks and trade wars. Fears of a US recession were replaced, with stock markets hitting record highs.
I think 2025 was the year of the up crash.
In a word, the past year has been a
roller coaster.
I think I'd run with enthralling.
In a word, I would say resilience.
China, 67%, that's tariff.
In April, Donald Trump's Liberation Day tariffs on allies and enemies shredded the global trading system that had delivered economic growth for decades.
And it really was panic.
It was a pretty big shock on the day that it happened.
That level of uncertainty, not knowing where things were going to settle, who was going to be affected with what tariff.
The Australian chief economist of global investment bank UBS, George Tharanou, was in New York as the announcement was made.
It was surreal seeing the markets move to meltdown amid the uncertainty of Trump's tariff policies. Investors we were talking to were seeing a very sharp correction in a lot of asset markets, equities and the Aussie dollar.
Audacious and slapdash, the tariffs even cover penguin-filled islands that have no human residents.
There was no logic in economics for those tariffs being levied at the particular level that they were put at.
We had the headline shock, and then markets clearly didn't like what they saw, had a bit of a correction.
Tensions between the world's big superpowers escalated before the Trump administration hit pause.
If there was one word that summarises last year, I think it would be taco. You know, the idea that Donald Trump will chicken out on some of his policies.
President Xi is a great leader of a great country.
The temperature dialed down and nations made deals.
We went from really worrying about what could have been quite large downside risks to global growth in the wake of what could have been a global trade war to something where those downside risks disappeared really quite quickly.
Locally, we had other problems. The Reserve Bank had held interest rates steady at 4.35% for more than a year, punishing those with large housing debts as it tried to force down inflation.
There was undoubtedly a lot of tension. We know households were really doing it tough.
Consumer spending slumped. Then, in February, came the first of 3 rate cuts after 13 hikes.
I think the pressure was there because we could see inflation was coming down. We could see the economy was really, really sluggish. If the bank hadn't cut rates then, it really would have been very difficult for them to explain.
For a while, it looked like inflation had been tamed, with price rises slowing to 1.9% in the year to June. Fast forward to October, and annual inflation is tracking at 3.8%, above the RBA's 2 to 3% target range.
The challenge has been that the recovery that we've got potentially is already starting to lessen the scope for inflation to fall.
Dashing hopes of further rate cuts and putting rate hikes on the table in 2026.
In all likelihood, inflation remaining above the RBA's target band over the coming months and quarters. And that's really going to take the period where they've missed their target to a 5-year long period, the longest on record. So I think begrudgingly, the RBA is going to shift towards raising the cash rate.
We think that a rate cut is still possible, but you need a lot of things to go right. We need to see the inflation numbers come back down again, and we know that inflation can run hot and cold.
The jobs market remains strong. The unemployment rate's 4.3%, and the economy's grown 2.1% in a year. Markets set new records in Australia, the US, UK and Japan, driven by the fear of missing out.
The higher the price, the higher demand. People just want to get into asset markets and not miss out.
Despite a recent dip, the ASX 200 is up more than 5% in 2025.
We've seen the interest rate cuts. We've seen profits, particularly in the US, continue to surprise on the upside. And even though conditions have been on the soft side, we've avoided recession.
Massive investments in artificial intelligence are driving global markets, propelling the so-called Magnificent Seven tech stocks most exposed to the boom.
These companies have genuinely delivered the earnings growth, and so that's a big difference from that tech bubble that we saw in the late 90s.
huge amounts continue to be invested in data centres, factories and technology.
I think that number is now close to $500 billion, which is a huge number, and I guess is forcing people to accept that this is a new innovation cycle.
With big money comes big risk.
I think there's a bubble. I think it may deflate rather than burst, but markets are stretched. That is no doubt about it.
So, what can we expect in 2026?
Volatility.
So I think it's just going to be another captivating year.
And I think the key question next year will be bubble or not.
The other word I'd probably use is uncertain. Or maybe the better word actually is just risky.
Risky business, indeed.